Thanks for being with us, Ajay. We are going to kickstart earnings season. Do you think the markets are worried about Q4 earnings? Is this anything to do with what to expect from Infosys and hence the Q4 earnings season, or this is just a normal consolidation that the markets are going to see since they're trading at high levels?
Yeah, markets have really outperformed. India is the top performing market, especially in dollar terms, given the appreciation in the rupee as well. So we are seeing a bout of consolidation coming in, and it's more geopolitical risk, which is having an impact on the market for the last 3 days. And domestics have been absorbing that supply. But that is what is really causing the market to stall a bit. Markets have outperformed, and it's natural. They will take some time then to absorb the new guidances that are expected with the earnings season. So earnings season, the expectations are good because of the low base effect of last year, this quarter, where banks had taken very huge write-offs, and metals and materials were doing very badly. So we will see a pretty good pickup in this quarter numbers because of the low base effect. That is factored in by the market. If the guidances are poor, then the market might go down a bit. But otherwise, we see this market going up further.
Ajay, you mentioned geopolitical risk. How much can the markets correct on that geopolitical risk? Previously, we saw, the day the surgical strike happened, the market saw a deep gash and then recovered quickly. For the last few months, we've seen the markets not reacting to bad news too much. They recover very quickly. Do you think it's going to be the case this time as well? Do you think the corrections are going to be narrow? What would you do when the markets would correct?
Yeah, but it's spot on. You saw it in June when the Brexit happened. Markets went down sharply, and within a week we were back. When the Trump victory, it took a matter of few hours. Again, surgical strike, it was a few days that we were back. And last week, if you see, on the same day there was the Syria bombing. There was a bomb in the subway in St. Petersburg. And there was one more, the Stockholm terrorist attack of a truck driver driving a truck into the crowd. And the markets did not react that strongly. So that shows some amount of complacency. And that is true, especially of the US markets, which are in the 9th year of a bull market. So markets tend to get very complacent then. And it's also a function of the liquidity that is really chasing returns because of the very low rates in the overall global economy. We have seen risk-on assets getting bid up. So that's a factor. Now, what will happen if there is an escalation in Syria or North Korea? The last 1 hour news is good. Trump has gone on Fox and Fox News and said that we will not escalate Syria while criticizing Russia. And the Chinese Prime Minister has spoken twice to Trump to say that North Korea military solution is not the way. So clearly there's a dialogue happening. It could lead to de-escalation when this risk off could go off. But it's also symptom standing. Markets have done very well, and there could be a sharp cut in case there is any event that leads to a risk-off. And we have seen gold not retreating. Yen is still getting stronger. So markets are hedging the bet that what if something goes wrong? Because Trump has been shown to be very volatile, and he's not really anchored to one position. So he can say one thing one day, and the next day impulsively something else might happen. That's what markets are really preparing for. Despite all the good news we have seen in the last 1 hour, that should have led to some kind of a recovery. And as you were saying, around the world are spiking up. That shows a lot of nervousness in the markets. So might be a good time to stay on the sidelines, wait for the markets to come down a bit. and then re-enter.
Come down a bit, how much, Ajay? And re-enter, what would you buy?
Yeah, so come down, I am quite convinced that given the amount of domestic liquidity that is sitting on the sidelines, the domestics have not really participated. Across March, they were sellers, whether the insurance companies sold or the mutual funds abstained. But just reading the fact sheets of the mutual funds, one can make out that nearly 30 to 35,000 crores of cash is sitting in equity mutual funds, which will get deployed at lower levels. That is what is lending a lot of support. Otherwise, nearly about 2,000 crores went out in the last 3 days from these markets in terms of FII outflows, and we saw the market still holding strong. So it's more the DII factor which is playing in the markets with the FII flows weakening. How much it can go down? Probably, you could see a 3 to 5% cut. That's the worst case scenario that the market is working on. Mostly, we are seeing that 9,000 is a very strong support, apart from intermediate supports for the Nifty. What to buy? I think very difficult to find value in this market. Most of the sectors are extremely overvalued because of the growth being factored in. So we would say that one has to stick with the growth sectors. If you go by valuation, then it's very difficult. You'll probably buy only IT, a bit of pharma, which is again at a 20 PE, so not very cheap, a little bit of oil and gas, some utilities. That's about all that's below the market price earnings or price to book. Most of the other sectors are higher, so we have to go by growth. Growth is in durables, growth is in cement, all the home suppliers, the beneficiary from the infrastructure and home initiatives of the government. So all the home improvement companies, cement companies, housing finance companies, NBFCs, private banks, I think these would be quite easy to pick and buy on the basis of growth. Valuation wise, very difficult market, but that's been true for India for years on end. We are never a cheap market.
Right. Ajay, you said you buy a little of pharma, IT and maybe oil and gas because valuations are cheap and you would rather bet on growth. Now, don't you think that when the markets go up, they lift all boats, the tide lifts all boats along? Aren't investors going to be better off looking at these lower valuation, lower valued stocks rather than the growth stocks which are very pricey? What would you say here?
Yeah, you see, IT, we have suffered in holding IT. That was a contrarian call. I felt that the valuations are looking good. And, the model is very clear. We said, okay, even if they deliver 8% dollar level growth, 2% dividend payouts, and 2 to 3% in terms of share buyback. So you are getting a 13-14% return from good managements who are pretty pro-minority shareholders. There's very little pilferage of revenue by these managements, very clean managements. But what we have really seen is that the growth is stalling, the business models are broken, and very few managements have a clue of how to invest for the cloud, for digitization, for Internet of Things, how to reorient their workforces from low-cost competitive advantage into a higher value-added competitive advantage. The Amazons, the IBMs, the Oracles have done a much better job. Second, in terms of using their cash hoard, either in rewarding shareholders or in doing mergers and acquisitions and buying out either market share or new technologies. Again, we have lagged in that, except, US-based companies like Cognizant, who have been at the forefront. But the Indian headquartered players have really lagged on that. So IT, we are coming off underperformance of 2 years. It should be a classic buy on a contrarian sense. but we would wait for the management guidance. It's looking like there is pain of 2 to 3 more quarters, if not longer. So fresh investments we would not do. We would not short IT because we think it's very much near the bottom. Very little space more, maybe 5% more it goes down. But we'll have to see who are the players who adapt to the new reality. In terms of pharma, I think there's a definite improvement in the quality part. Quality councils have been set up, and we are seeing more FDA approvals than FDA bans now coming through. So it will start improving. But pharma has the case in the US, the Department of Justice case, which will stall them, the pricing collusion part. Second is in terms of the Indian pricing and all the populist remarks from the government. So Delhi government is talking about free medicines. A lot of other state governments are catching up on that. So there could be some headwinds for pharma on the regulatory side still. But on a valuation wise, at 20 times price earning, not cheap, but not as expensive as they used to. And given the kind of growth that's there, I think a few pharma, select pharma, we would really look at.
Right. Ajay, you spoke about IT. You said the bottom is perhaps a couple of quarters away. We're going to get earnings coming in from Infosys tomorrow. What are your expectations? Do you think there will be an announcement for a buyback? Will that really lift the stock up? It's again back below 1,000 rupees a share.
Yeah, clearly, with Wipro having announced a buyback, TCS having announced a buyback, HCL Tech having announced a buyback. And that is the model, the 8 plus 2 plus 2 is the real model that investors are looking at technology. And Infosys sitting on such a large cash hoard. So there is a very strong street expectation. And there will be a deep disappointment if there is no mention of a buyback, because they've really not been using that cash, cash lying in fixed deposits or liquid funds earning 6-7% pre-tax is really bringing down the return on equity. So you give that money to shareholders as enhanced payouts or through a share buyback. I think that is being very keenly watched. Apart from what is the margin delivery, what is the revenue for this year, and main thing is what is the revenue guidance for next year. We have seen a lot of IT companies talking about layoffs, talking about automation hitting their main coding business. So how are these businesses going to now resurrect themselves, pivot themselves into the cloud, into other modes? That we have seen the US-based companies do very well. And tomorrow the Infosys guidance will really be looked at very closely. The management announced they would have a strategy for cash nearly 2 years back. We have not seen that strategy at all. The investors have been very patient with this company given its track record. But I think investors are losing patience given the dismal performance. So I'm not giving a buy or sell. I'm just giving the analysis. Please check with your broker or your advisor before you decide on that stock. But I'm just putting through the facts.
Right. So when we do kickstart the fourth quarter earnings season, what will you be watching out for? Do you think it's going to be ahead of what the street is estimating? Because post demonetization, the estimates were brought down. And once the third quarter earnings came, everybody said it's better than what we were expecting. So fourth quarter should also be good and earnings should be strong. Which camp are you in? Do you think the maximum impact of Q4 of demonetization will show in the Q4 earnings, or do you think they'll be better than expected?
I don't think they'll be better than expected. As I said, because of the low base effect, there is expectation of better earnings for a few sectors like banks. Public sector banks, the run-up has been on the basis that they have taken most of the write-offs that they needed to. Market that they are still underprovided. There is no tangible move from the government to address the NPA issues. So NPAs are nearly 80-85% of the net worth of public sector banks. You look at performance-wise with a 72-73% market share, they are delivering about 15% of the revenues and the post-tax returns of the sector. So clearly, on a logical basis, there is no case to invest in public sector banks, but they've given 40% returns. So that shows that they were beaten down too much, and the market is still hoping for some positive action, and that is baked in. So public sector bank numbers will be better than last year. They won't be better than expected because the market is baking in a better return. The metal sector will show very good numbers because they had very dismal last year, this quarter numbers. Telecom will be poor, that is expected, so it won't be beneath expectations, but telecom will remain poor. Auto is expected to be poor on the demonetization and two-wheelers continuing to suffer, tractors doing well, passenger cars doing well. The yen appreciation will have an impact on passenger vehicles. Commercial vehicles not doing well, that is again as per expectations. FMCG, we will really look at, is there any volume pickup? Given that February, March, we had reached about 60% of demonetization and the rural economy would have benefited from the expenditure of the UP election. So is there any pickup in the FMCG numbers? Durables will have very good numbers again. We have seen a sharp pickup in durable offtake, and that will reflect in the numbers. Pharma, IT, subdued numbers, not expecting too much, should not be below expectations either. So overall, expectations are mixed. Because of the low base effect, we know they'll be better than last year, and we are expecting they should deliver and not disappoint too much. That is what the street is factoring in right now in these levels of the market.
All right. Ajay, thank you so much for speaking with us at NDTV Profit.